Hey everybody, how are you? My name is Yvette Best. I'd like to thank you for this opportunity to be able to talk to you today in reference to the 2021 tax updates. Most people know we have had a slew of new tax laws this year, and I just want to be able to share with you about how this may impact your return and things that you need to know going into next tax season. Most people know that tax year is a year behind. So next year in 2021, we will be preparing the 2020 taxes. But at that time, it's usually too late to take any action if you're not ready. So the main thing is for this presentation is to make sure that you are ready for tax season next year, that you are aware of different things that may impact your refund, how to make your refund better, and also to avoid a tax time surprise. So let us start. First, who am I? Who am I to be able to talk to you about this topic today? Again, my name is Yvette D. Best. I have 30 years experience in taxation. I have been a tax practitioner since 1989. I am federally licensed to represent taxpayers in all 50 states. I am an IRS enrolled agent. I am the owner of Best Services Unlimited, which has been in existence since 2006. God willing, next year will be our 15th year of successful business. I am also an international best-selling author of 4 books, 3 about taxes and 1 about business. And I am the only A-rated woman-led accounting firm in Fayetteville, Georgia. My motto is death and taxes in life are certain, but knowing how to pay only your fair share is third. And I have been published in several financial websites and articles, and I am listed on the IRS directory of federally qualified tax professionals. So, what are the basics? So we still got 7 tax brackets. That has not changed. And most of these things that I will be talking about will not change until the year 2026. We still got 7 tax brackets, the lowest being 10%, the highest being 37%. We still have the child tax credit at $2,000. Please note that $1,400 of that $2,000 is actually can be refundable if available to you. We also have that new non-dependent credit, which is $500. So usually I would talk about how we would have the lean year when your teen turned 17 and you didn't have a credit. Well, now we do have one credit in place and it's $500, but it's not only for kids. It's also for people who may have lived in your house for a whole year and they are other dependents. This is why it's the non-child dependent credit, or also known as the other dependent credit. There also is an increase in the standard deduction. You have single or married filing separate, which will be $12,400 for 2020, as well as married filing joint, which will be $24,800, and head of household will get a bump at $18,650. We also have the 20% pass-through deduction, also known as the qualified business income deduction, or QBI. That is still going to be in play for people who have businesses, whether it is pass through where they're using a S corp and they're passing this income onto their personal return, if they're in a partnership and they're passing this income onto their personal return, or you're filing a Schedule C form. Please note that there are a phase out limitation for this. And for single filers, that amount for 2020 is $163,000. That's total income. And for married filing joint is $326. Then we have the Affordable Health Care Act impact. Luckily, 2019, they repealed for you to have minimum essential coverage. Most that was the buzzword that you had to have healthcare. If you didn't have it, you were getting penalized. This was erased with the 2019 tax filing, which was this year, and that will continue to 2026. So if you do not have health coverage, you can definitely get affordable healthcare, but if not, you will not be penalized tax-wise for not having healthcare. And then let's talk about educational benefits. I'm going to talk about some more later in this presentation, but I wanted to talk about Section 529s. That is huge this year because this is the first year we were able to use 529s to be able to pay for private school tuition for students that were in grades K through 12. You want to be able to utilize those funds, and 529s are a great way to save for your child to go to college, as well as using Coverdell or using a Roth IRA. These are just saving mechanisms to be able to help pay for your child to go to college. But now with 529s, you are able to open up the opportunity to save in these accounts and pay for private tuition for your child who is going to grades K through 12. Also, with 529 plans, assets can be transferred to ABLE accounts for family members. Now, ABLE accounts are set up for people who are disabled. So most people know that people who are disabled may receive government benefits. So that kind of limits the amount of assets that person may be able to have. But with an ABLE account, you are not that does not is not included in their income calculations. So it is a good savings mechanism long term for someone who is permanently or totally disabled. And another note is 529 plans, contributions up to $4,000 for single filers and $8,000 for joint returns is also deductible on the Georgia state tax return. Now, for the people who are listening from other states, please look into see how much can be deducted in your state for your 529 plan, because most states do have a deduction available for the 529 when you are contributing to it, and that is something to help you save on your state taxes. Now, let's talk about the refund. 5 surefire tips to get a bigger refund. So tax time is all about the refunds. People can tell you they don't care, they want a refund. They're lying. They like refunds. Everyone wants to maximize their tax refund because nobody wants to pay Uncle Sam. And after all, it's your money and you should be able to get all of it back. But everyone's financial situation and tax situation is unique. So what makes a big refund for one person may not work out for the next. But these next 5 tips, which mostly can work for every taxpayer to help them increase their refund. So number 1, you want to consider your filing status options. So for married people, they have more wiggle room because they can file married filing joint or they can file married filing separately. You want to calculate both of these options, especially next year. This is also for married filing joint couples who also have student loan repayment plans. It will probably be best for you to file separately so you're only going in with your individual income to lower your repayment back to your student loan lender. And then for individuals who have dependents, they are able to file head of household. However, this head of household status is also available to single filers who also take care of their parents. So you want to make sure that if you have your parent, aunt, uncle, grandparent living within your household, you might want to investigate and talk with your tax professional about the head of household status. So 2, you want to maximize your IRA contributions. Now, if you are able to contribute to a IRA, you would like to do so because it lowers your taxable liability before we start to calculate tax. It's an adjustment to income. What you will do is you can max it out. If you're under 50, that contribution is $6,000. If you're over 50, that contribution is $7,000. And it also calculates if you're doing 401ks or some other type of retirement. There's a calculation that lets you know what is the max amount you can put in. Also, another trick is people sometimes make non-deductible contributions to their IRA, also known as a backdoor Roth. That is also an option to help you be able to put money away during the year. And if you like to be able to exercise a backdoor Roth, you have to talk to a financial advisor for that. But also, if you decided to file your return and then make a contribution to your IRA, you can then amend your return and add that contribution as long as it's done before tax day, which is slated for April 15th of 2021. And one good thing about amended returns now, we are able to e-file them. So that's also a plus for if you decide to make a contribution and amend your return, you'll get your refund back just a little faster. So 3, you want to make the most of small business tax perks. If you received a 1099, surprise, the government actually considers you to be a small business owner. Not only does this mean that you report the income and expenses on Schedule C and self-employment tax, which is the Social Security and Medicare that was not taken out when you were receiving all the funds because you were receiving it straight cash or payments. Taxes on your taxes on the net income, but you're also allowed to deduct expenses related to the business, such as vehicle mileage, which is 57.5 cents a mile. That is huge when it comes to this tax deductions. So think about it. If you drove your car for 10,000 miles in 2020, you already have a $5,800 tax deduction for your car usage. So tracking the mileage, making sure you're keeping track of your business expenses, and is seizing the opportunity to receive 1099 income is huge, especially for people who are W-2 employees, because let's face it, your deductions are very limited, and business owners do have almost 475 deductions. So getting 1099 income is great because it opens up and unlocks the key to maximum tax deduction potential. Number 4, you want to consider changing your W-4 with your employer. So you start a new job, you fill out a W-4, but this needs to be reviewed every year. And when the case comes, if you receive a raise and or a bonus, you should review your W-4 form, because it basically lets the company know how much money to take out of your paycheck. And if you don't withhold enough, you'll get a tax time surprise. And then you don't want that. We have irs.gov, and it has a tax estimator to let you know how much you can actually withhold. You use your pay stub, you go through the steps, and it will tell you exactly what you need to do and how much you need to withhold to make sure that you do not get a tax time surprise. Also, now the W-4 is much easier to complete because we do not have personal exemptions. So without the personal exemptions, what you're going to do is make sure that you use the correct filing status. And if you do have children, in the middle of the form, you can indicate how many children you have by indicating the child tax credit that you would receive on your return. Also, if you have multiple jobs, there's a checkbox for that. So if you have 2 or more jobs, you want to take and check that box to make sure that they're withholding enough money to cover not only the money coming from both of the jobs, but the impact of your tax bracket when that income is added together. Because remember, you are taxed on worldwide income. So another tidbit is for married filing joint couples, double income households. Most people who are married will file married on their W-4s, but that may not be advantageous for you. Just based on my years of experience, when I have double income households, both of them are filing married. Even when we had exemptions and they were doing married and zero, they were being a little bit short when they came to the tax table, especially now since we are not itemizing. Since the standard deduction is high and most people who live south of the Mason-Dixon line are not itemizing, you are having a shortfall when it comes to the time at tax time. So I would consider either doing the W-4 and withholding your income at the single status and at most at the head of household status. So that way you just have just a little bit more taken out of your check to make sure that you do not get a tax time surprise. And then lastly, credits are more advantageous compared to deductions. And this is because they reduce your tax liability dollar for dollar instead of a portion of your income. So when you have deductions such as business expenses, it just lowers the amount of money until you get to your net income. But then you're taxed. But credits reduces that tax liability dollar for dollar. So credits such as the American Opportunity Credit or the Lifetime Learning Credit for education expenses are great, as well as this tuition and fees deduction. Also, you have Child Independent Care Credit for paying for children who go to child care. And this dependent care credit is also available for parents and other family members who are dependents on your return, who are permanently and totally disabled, and you have to pay someone to take care of them. This is also deductible on the return as the Child Independent Care Credit. Also, when you're giving money to your 401ks at work, you get eligible for a tax savers credit. And depending on your income, you can get a credit for that as well. And all of these credits reduce your income dollar for dollar, except for the tuition and fees deduction. That is basically an adjustment to income. So basically it lowers your income before you actually receive tax. So let's review 5 tips to a bigger refund. 1, you want to consider your filing status options. 2, you want to maximize your IRA contributions or talk to your advisor about having a backdoor Roth. 3, you want to make the most of small business tax perks. 4, you want to always consider changing your W-4 once at the beginning of the year. And second, after you receive an increase in your salary, meaning your yearly raise and or bonus. And then always remember number 5, credits are more advantageous than deductions. So when in doubt, go with a professional. Just do yourself a favor and go with a professional. You're unsure, you're confused, ask for help. Seek professional help. If you already have a tax professional, that's great. Make sure you work with them. So things that you need to work with them this year. It will be the best thing that you can do before the end of this year is to meet with your tax professional and tax plan. You need to have a look at what your taxes are going to look like next year. If you received unemployment this year and you didn't withhold enough taxes from it, because there are states that did not withhold taxes from that $600 benefit. You need to know how that's going to impact your return. If you receive money from your 401k and you know that you're splitting this money over 3 years, you don't have any withholding, you need to know how much of that tax is going to impact your tax return this year. It's just that this year is just a unique year because of COVID-19, the influx of the CARES Act, and we're going to be impacted by that at least for the next 3 years, because especially people who have taken money out of their retirement and asked for it to be taxed over 3 years. So you just want a tax plan to make sure that you have everything in place and the return is filled out accurately. So I want you to always remember that Uncle Sam is not your uncle. You can't claim him, but you do have to pay him. And I don't want you to have to pay him next year. So please, if chance, re-listen to this webinar, take in the steps, and please make sure to meet with your tax professional before the end of this year, because you want to make sure that you're on the right track. If you do have a little shortfall, you can also take and make an estimated payment on January 15th of 2020 to help you, or be able to at least know what you need to save between January and April of 2021, so that way you can be able to pay Uncle Sam on time. The reason being is they just increased the penalties and the interest for overdue accounts, and you just don't want to be having to pay more money than necessary. Also, I wanted to take a moment to talk about the payroll deferral that everyone is talking about and up in arms over. So federal employees, you do not have a choice. They're going to give you the payroll deferral. Some people are able to opt in and opt out. Me personally, I just think that if you can opt out of that decision, just do so, because then you're going to be double taxed next year, and that's not no fun. So just think about it. We're getting ready to go into fourth quarter. You have 3 holidays coming up: Halloween, Thanksgiving, Christmas. This is the most time people are spending money, money, money. So just think about it. I get some extra money this year because they stopped withholding my Social Security. Then you use that extra money for the holidays. Then next year in 2021, usually first quarter of the year, people are using their money to pay back the money they just spent the year prior. Now, not only are you going to be short with money, you're also going to be short because they're going to be recouping all the money that they just gave you in October, November, and December. So who wants to do that? So if you can opt out, it's fine. If you cannot, I would highly suggest that any extra money that you receive in your paycheck, you just put it to the side, put it into a savings account, and save it to be utilized in the new year. That's the best thing I could tell you to do. So, first of all, I'd like to thank you. Thank you today for giving me the opportunity to talk to you for Financial Fit Fridays, to get you ready for tax season, because tax planning is a year-long event. It is not something that you can do fourth quarter. You should be putting taxes in your mind every month of the year, especially with all of these changes that have been put into place. So please make sure you reach out to your tax professional before tax time comes, so you can have a chance to know how you're going to be looking next year, what a glimpse at what your refund could possibly be, and so you can be ready. Um, First of all, I love sharing knowledge with people. So I do have a free 15-minute consultation. You can reach me at bit.ly/increase bottom line, to talk to you about what do you do if you didn't withhold enough taxes from your from unemployment. What can I do to minimize my taxes if I took this retirement withdrawal? What can I do to maximize my business expenses? All of these things can be answered in this consultation. So just feel free to reach out to me, because I love to be at service, especially for taxpayers, because I do a lot of tax debt resolution, and you do not want to owe the IRS. These penalties are huge. The interest that they levy are daily, and you just want to make sure that you're on the right side of the IRS and do not receive a tax time surprise. So again, I just want to thank you for allowing me to talk to you today on Financial Fit Fridays, and I just want you to go forth, be great. We will get back to normal, and this too shall pass.